this particular webinar, we will be doing capital asset pricing model. Just to have a recap of what we did last time. Last time we had talked about how to compute variance, right? And just to revise the formula, in a two security case, this is the standard deviation of a portfolio of two securities, wherein x1 is the proportion that is invested in security 1, x2 is the proportion that is invested in security 2. Standard deviation of 1, standard deviation of 2, right? Correlation coefficient, right? So if you are having two securities, you have three estimates or three figures that you want. If you have, let's say, 4 securities, then in that case you would have 4 plus 4 n into 4 into 3 divided by 2, 6, 4 plus 6. You would need 10 estimates, right? Now, if in case you have 25, 30 securities, the problem becomes more and more compounded, and it is extremely difficult to try and find out what is the relationship of each security with the other. So therein lies the importance and benefit of the capital asset pricing model. A very simply defined, capital asset pricing model, if we just remove the theoretical, in terms of how it is derived, the fundamental assumption is that instead of trying to relate one security with the other, right, we try and relate the security to that of the market. Right? We try to relate all securities to a common benchmark, that is the market. In this case, the prototype or the benchmark that we are taking to the market will be an appropriate index. Right? Now, what we know, or it has been proved, is that in terms of the return of a security, if you look at the return on any particular security, we find that it is composed of 3 elements. Right? One is economy, industry, and the third is company specific. Right? Now, if you look at a particular stock, right, and you can take any particular stock, for example, just to take an example, if we talk about ACC. Right? Now, it is a cement company. Can we actually logically say that the performance of ACC is not at all dependent on how the economy is going to function? Can we actually say that? If the economy is going to move, there is money to spend on housing and construction. Only in that context would we find that the stock of ACC would perform. So, plus suppose, for example, let's say the government reduces the excise duty on, let's say, cement. Okay? Automatically, what will happen? The price of ACC would obviously go up, because we do know that there is a relationship between the price and the demand. So, in case if the price of, let's say, the cement bag comes down, so obviously the quantity demanded of cement would go up, and it will automatically translate into higher sales for ACC. So to that extent, even the industry factor, specific industry factor of reduction of excise duty on ACC is going to have an impact on the ACC stock. The third impact, of course, would be in terms of the company specific factor. Now, for example, let's say the chief executive of ACC suddenly resigns and leaves the company. Now, without any succession plan, without having an appropriate successor, if the chief executive suddenly resigns and leaves the company, it is bound to have an impact, but it is bound to have an impact only on ACC. Right? It is not something that it is going to affect all the cement companies. And that is a company specific factor. Now, what the CAPM actually says that if you are looking at these 3 factors, that a particular return on a stock is dependent on, let's say, economy, industry, and company specific. Right? Now, if you look at the stock market, as I said, the market, the index can be taken as a benchmark for the nation's economy. So, depending on how the nation does, right, it will have some of the impact on a particular company's stock. What impact and how much relationship it has, that of course needs to be measured, but definitely there is a relationship between, let's say, the entire performance of the economy and the performance of the stock in question. Right? So what he has said that this entire volatility of the returns of a particular stock can actually be divided into 2 parts. One is systematic risk and the other is unsystematic risk, right? Systematic risk and unsystematic risk, right? Now, systematic risk called as undiversifiable risk. Now, when I say undiversifiable risk or market risk, what I mean to say is that if the particular stock market is moving in a certain direction, right, I can expect that depending on the relationship that the stock has with the particular benchmark, the stock would also exhibit some sort of a movement which is akin to that of the market index. Now, for example, that let's say we assume that a stock market would move up by 10%, then in that case one would expect that depending on the performance of or the relationship of the particular stock in question, the stock also would move by a certain percentage. This percentage would vary not only from stock to stock or from security to security, but even for the same security from a different point depending on the absolute importance of either the sector or the performance of the stock in question, right? Because the business model of the stock keeps on changing. There may be, in terms of when you take the particular benchmark as an index, now the composition of the index changes. So possibly when you look at, the index is normally based on market capitalization. So if there is a certain market capitalization of particular sectors, so obviously the relationship of that particular stock with that of the index will also automatically undergo a change. In terms of measuring that relationship of the stock with that of the market can be done through something called beta, right? Now, there is, how do you calculate beta, right? Now, one way, of course, is to simply, estimate it. You can run a regression line between the stock market returns and that of the particular stock in question. So, when you run a regression line, so there is a particular slope that will come. Right? For example, when you run a regression line between price and quantity, you have a relationship of A and BP, A minus BP. If you have price and quantity, this is a negative relationship. So you would have a negative relationship or inverse relationship. But for example, if you are looking at beta, right, in most likelihood, there is always a positive relationship between the stock in question and that of the market. So we would expect the slope to be positive. It may be less or it may be more than 1, but we do expect that the relationship will be positive, especially over long periods of time. Right? For short intervals of time, if the stock market is going down, right, and the stock is moving, we may have a negative slope, but that is only something which is it is only probable only in short durations of time, and it is otherwise not a market reality. In most cases, you will find that the relationship of the stock with that of the market is always positive. Of course, the relationship, depending on the nature of the stock as well as the composition of the index, will differ from time to time and from stock to stock, right? And of course, from index to index. For example, if you take a BSE Sensex, you take an NSE or you take a 500 index. So, if you look at a particular stock, so the beta value that will come with respect to each stock is going to be actually different, right? So, the first way, as I said, you run a regression line and you run a regression line and you find out the figures of A and B, right? So B, of course, would be beta, and A is the intercept, and it simply indicates that if the level of the market is 0, what will be the returns on the particular stock, right? So this equation actually can be, this regression line can be interpreted in this particular manner. The returns on the stock, for example, let me say that the stock, the X, is equal to alpha plus beta into Rm plus there is an error term, right? Now, as I have already indicated, right, some of the returns of the stock can be understood by the returns, understanding the returns from the market. Since it is closely aligned with that of the market, so some of the, as the stock market moves up and down, that relationship can be explained and quantifiably measured. But there is some aspect of relationship which is not dependent on the particular stock market or economy or industry. In that case, it is a company specific factor. Those things is represented, the factor which is not represented by the market is represented by the error term, right, which can be also represented by E. Right? Now, if I have to measure the error term, right, once I run this regression equation, right, I will get the calculated values of alpha and beta. Right? For example, I have actual market data of returns on the stock and returns of the market. Right? I run a regression, I will find the line of respite and I will get the values of alpha and beta. Now, using that particular equation, if I now find the calculated value of the stock, right? Once having found the values of alpha and beta, right, I use whatever is the actual values of the market, right, and I start on the basis of those values, I actually find the calculated value of the stock. Now, one will find that there might be a difference, right, because ultimately it is a line of respite. There may be a difference between the actual value of the stock, right, the actual return on the stock, and the calculated value that we are getting from this equation. The difference between the two is represented by the error term, right? Because, as I said, whatever we are getting is in terms of this part of the equation, alpha plus beta into RM. So this is the equation that we are going to use. The calculated value, if I say, is this, right, represented by RM, and this is the actual value. If I subtract this, I will get an error term, right? Now this part is the, what you would say is the value that is not, is the part which is not explained by the market and can be represented as the unsystematic risk, right, which is represented by the unsystematic risk. So what basically the capital pricing model says, that the entire risk can be divided into systematic and unsystematic. The total risk can be represented by variance. The total risk can be approximated by the variance. In terms of, if I have to break this up into systematic and unsystematic portion, right? So what will happen is, if I want to find a systematic portion of the risk, I can do it as square of the beta of the stocks into multiplied by the variance of the market. This would be the systematic part, and the square of the error term would be the in terms of the percentage of this vis-a-vis, suppose I take this divided by, right, the systematic risk divided by the total risk. The higher the percentage is, right, the greater would be the portion that would be explained by the market. Right? So I could possibly say that in this case, I could explain a sizable portion of the returns of the particular stock is dependent on that of the market. Right? Now, what the capital pricing model further says in this regard is that when I say systematic risk, it means the risk that is not possible to be diversified away. Right? Which means that if I am holding a security, and since it is dependent on something which is that of the market, right, I cannot diversify it. If it has a relationship with the market, so if the market is suffering some volatility, there is absolutely no doubt in the mind that the stock in question would also suffer some volatility, right? So one cannot avoid that degree of volatility, it cannot be diversified away. However, if I were to combine these securities, right, if I were, however, possible to define, combine the securities, by possibly by looking at covariance and stuff and all, the unsystematic portion can be diversified away, right? So if I can diversify the unsystematic part, what I will be left with is only the systematic portion. So the return that I would need should be commensurate with the risk that I am bearing, and the risk in this question is the systematic risk, right? Now this takes us to the security market line. Right? So the beta can also be measured in this following manner. It is covariance of the securities returns with that of the market. variance the market returns. Covariance of the securities returns with that of the market returns, right? Divided by the variance of the market returns. Right? This is what beta can also be calculated in this manner. Now, going a step further, right, what he says is that since I cannot diversify that risk, like beta is a risk that I cannot diversify away, I would require a return that is at least commensurate with the risk that I am bearing. So my required return has to be in sync with that risk. So he defines a model which is as follows: the required return on the stock, which I have represented by RE, or it can be represented by KS. These are the two notations that one normally use, is equal to RF plus beta Rm minus Rf. Beta, as I said, is the systematic measure of the systematic risk. Rm is minus Rf is the market risk premium. Now, what it in effect means is that for investing in the market, right, there is an additional risk premium that I have to bear. The market risk premium is going to differ from market to market. For example, if I am investing in the equity market, now there is a risk premium that I need to bear because of the particular market that I am investing in. For example, here in this case, I may expect that in the stock markets, I should get a return of at least 15 to 16%, otherwise I should not invest. Now, if the risk-free security return is, let's say, 6%, right? So that means the market risk premium that I want is 10% at least for investing in the stock market. Now, if I were to choose to invest in the debt market, maybe I would be satisfied with only 13% because the risk nature is, it is not so risky. The volatility is not so high. So I will settle out with a lesser return. So in that case, the market risk premium of the debt markets would not be more than 7%, whereas that for the equity markets is something like 10%, right? So what in effect he is saying is that if the market returns are, let's say, 16%, right, and the risk-free return is 6%, and the beta is, let's say, 1.5%, again 6, right? So this is 6 plus 1.5 into 10. 1.5 into 10 is 15 plus 6, 21%, which means that if the securities beta is 1.5, the returns of the market is 16%, the risk-free rate of return is 6%, I should expect a minimum rate of 21% on the particular stock, without which otherwise I will not invest in that stock. If the stock is not expected to give me a return of 21%, in that case I would not like to invest in that particular stock. Right? There is something called a security market line, right, which is used for both stocks as well as portfolios. Right? For example, you can have a beta of a particular stock. You can also have a beta of a portfolio. Right? The portfolio beta is nothing else but a weighted average of the individual betas multiplied by the rates in which they are invested in. Right? So you will have, let's say, portfolio beta. So beta of a security multiplied by the percentage of investment that is invested in security 1 plus. So this will how be the portfolio beta. And if I have to calculate the variance of the portfolio, right, it would be nothing but square of the beta, portfolio beta, multiplied by the variance of the market plus the error, square of the error term. Right? Now, of course, in a diversified portfolio, we can safely say that this part, the unsystematic portion, since in a portfolio it is possible to diversify it, so we can say that this portion is 0. So what we are left in a portfolio is that the risk of a portfolio in a well diversified portfolio is composed of only the systematic portion, which can be approximated by the.
There is no error in that case. There is no error in this case.
If we are able to diversify the analysis, so that in that case, the risk is composed only of the systematic risk. What we are saying in an efficient portfolio, yeah, in an efficient portfolio, we should be there should be no error term, right? So in a well diversified portfolio, if it's a good fund manager, this unsystematic portion can be actually reduced. Right? This is what we are saying. Right? Theoretically, it may not happen, but practically speaking, and actually, if you look at estimates, right, you will find that in portfolios, you will find that actually the CAPM model works because by combining securities, it is possible to reduce the unsystematic portion. But if you are talking about particular securities, the risk of the security, there will be a sizable portion of systematic as well as unsystematic risk. And if you are computing the required rate of return only on the basis of systematic risk, to that extent there is a underpricing of the risk. So the required return that you are using by using beta is actually a required return which is actually less, because you are only accounting for the systematic portion of the risk. You are not accounting for the unsystematic. Whereas in a portfolio beta, good approximation, and by using the portfolio beta to estimate the required rate of return, one is still safe because the estimates are much better. You find that it is more accurate. Right? This is by empirical evidence. So what you will find in a security market line, right? This is the SML, right? This is the beta, and this is the return. Right? This is the risk-free rate return. The beta of the market by definition is always equal to 1, right? The beta of the market is always equal to 1. This is the RM, and if the beta is 1, right? This is the returns in the market. So if a security has, let's say, a beta of 1.25, right? Now this is the return that it should have, right? This is the expected return that it should get, right? If the security is giving a return which is more than this, right? Then it means that their security is underpriced. But if it is the security is plotting below the security market line, that means that there is overpricing on that particular security. It is mispriced. To that extent, one should not go into invest in that security because it is overpriced, and one would not get the commensurate returns because in relation to its risk return profile, it has not been actually priced properly. So as I said, the security market line is used for both the portfolio as well as the particular individual security.